And we're going to put up a chart here, a line chart, that shows consumer discretionary versus consumer staples. And you can see the blue line, that one on the top, is discretionary. The white line is staples.
Yeah.
McDonald's, I think, is 4% actually the discretionary.
Wow.
So what is that telling us about what's going on in the economy?
Defense isn't working so well in the stock market, but I think it's that the economy is certainly a different place in the markets right now. I mean, as we looked at all these fundamentals, we'll see what this stock does as it opens.
I can imagine some people don't like to hear that. Reality is not what you see in the stock market right now.
Well, there's a big decoupling. We've had great numbers, great earnings coming out of the street, and the stocks are just sitting there, right? We've been building a top in here. Maybe that starts to move again, but I think it's hard to take a move like this and say a whole lot about the economy.
Why isn't safety paying off better right now? Because we've got a lot of uncertainty, geopolitical uncertainty, we've got trade issues. Every time you look, we've got a lot of uncertainty. You'd think that would be a flight to safety when it comes to equities.
And it actually should. I mean, David, it's a good point. But I think there's the thing that we're looking at and seeing at Highland is there's a lot of this issue about flow. Flow is really dominating markets just across the board, and the lack of flow when you're in these quiet periods in the stock market, who's the net buyer of equities? Who has been the net buyer of equities? It's companies. Companies have been the net buyer of their stocks. We're in the quiet period in here, right? So all the vol that we've been seeing has been in these quiet periods. So we'll see what happens when the quiet periods are over. Maybe the stocks start to react a bit better after that. But look, again, I think that defense is the right way to go. Overall, I think defense really wins championships in this kind of market.
Yeah.
But we'll see. The flow is really the focus for us. I think flow will dominate fundamentals.
But what about the individual investors? Are they coming back in now?
The studies show that there are some individual investors coming back in, but they usually time poorly. So
right, exactly. Is this like a warning sign?
Probably.
Mark, are you agreeing with this?
Well, I think it's difficult, right? Because net flow into the market has been only in two sources: companies themselves and foreigners. And if we look at what's happening in the hedging market for currencies, it's harder and harder to own dollar assets. It's 250 basis points if you're a European investor to own like credit in the U.S. That's making it harder for that flow to continue to flow this way. So I think as we think about these flow dynamics, it is overwhelming a lot of the fundamentals. And I know it's a broken record per se, but I think this is the thing that it makes it very difficult for a retail investor, mom and pops, to figure out why should they be growing their exposure in a market that doesn't look like it's acting properly.